So, you want to own a casino. Not play at one. Own one. The building, the floor, the vault, all of it. Picture it for a second. Rows of slot machines humming under gold light. A blackjack table where the dealer never stops moving. People flying in from other countries just to sit at your tables and hand you their money. It feels like the closest thing to a money printing machine that's still technically legal. The house always wins, right? So if you own the house, you always win too. That's the fantasy. Here's the problem. The house winning and the owner winning are not the same thing. And the gap between those two facts is where almost every casino owner in history has lost the plot. Let's start with what it actually costs to sit in the owner's chair. A large-scale casino resort, the kind with a hotel tower, a full gaming floor, restaurants, and a theater, costs somewhere between $1 and $4 billion to build from scratch. That's not a typo. Billion, with a B. The Cosmopolitan in Las Vegas cost close to $4 billion. Resorts World Las Vegas came in above $4 billion as well. If you're thinking smaller, a regional casino, the kind you find near a highway exit in a state that just legalized gambling, still runs you $200 to $600 million once you include the license, the land, and the construction. And that license is its own separate nightmare. In most states, a gaming license isn't something you apply for and receive in a few weeks like a business permit. It's an auction, a lottery, or a multi-year regulatory review, sometimes all three. In New York, when the state opened up 3 new downstate casino licenses in 2023, the application fee alone was $500 million. Just to be considered. Not to build anything. Just to put your name in the hat. So before a single card is dealt, before a single slot machine lights up, you've already spent more money than most companies will see in their entire existence. Now here's where the fantasy starts to look different from the reality. A casino makes money in a way most people misunderstand. They think it's about the games. It isn't, not primarily. The games are actually a fairly thin margin business. On the gaming floor, the house edge on most table games sits between 1% and 5%. Slot machines are more generous to the house, typically keeping between 8% and 15% of what's wagered, sometimes more. That sounds like a lot, until you realize how much of that money cycles back out in jackpots, comps, and player rewards designed to keep people at the machine longer. The real profit engine of a modern casino resort isn't the casino floor. It's everything wrapped around it. Hotel rooms, restaurants, nightclubs, retail, parking. In Las Vegas today, gaming revenue makes up less than 40% of total resort revenue for most of the major properties. The rest, the majority, comes from rooms, food, entertainment, and convention business. Caesars Entertainment and MGM Resorts have both said this publicly in earnings calls for years. The casino floor is the hook. The hotel and everything else is where the actual profit lives. This changes the entire nature of the business you're buying into. You're not really buying a gambling operation. You're buying a hospitality conglomerate that happens to have a gambling license attached to it. And hospitality is brutal. Occupancy rates swing with the economy, with gas prices, with whether a competitor just opened a shinier tower 2 blocks away. Restaurant margins are thin everywhere in the world, casino or not. You've essentially bought 4 or 5 difficult businesses stapled together, and all of them need to work at the same time for the whole thing to be profitable. There's another layer to this that most outsiders never think about, which is that a casino resort competes on novelty as much as it competes on odds or service. In a market like Las Vegas, a property can be the newest, shiniest thing on the strip for maybe 5 to 7 years before something bigger opens down the road and pulls attention away. Foot traffic in gaming is heavily influenced by simple curiosity, people wanting to see the newest tower, the newest pool, the newest show. That means part of your profitability clock starts ticking the day you open, and by the time your construction debt is anywhere near paid down, you may already be facing pressure to spend hundreds of millions more just to stay relevant against a competitor who hasn't even broken ground yet. You're not just running a business. You're running a treadmill that speeds up the longer you stay on it. Then there's staffing. A mid-sized casino resort employs anywhere from 1,000 to 5,000 people. Dealers, security, surveillance staff who watch the cameras 24 hours a day, hotel staff, kitchen staff, compliance officers whose entire job is making sure you don't accidentally break a gaming law that could cost you your license. Payroll alone on a resort like this can run into the hundreds of millions annually. And unlike a lot of businesses, you can't quietly cut corners on compliance staff to save money, because the moment a regulator suspects you're understaffed on the surveillance side, they can suspend your license. Not fine you, suspend you, which means the building goes dark and every other cost keeps running, while your only source of revenue stops completely. This is where we need to talk about the trap. Not the gambler's trap, yours. There's a concept in psychology called the sunk cost fallacy. Most people know it in the context of a bad relationship or a movie they keep watching even though it's terrible, because they've already sat through half of it. The idea is simple. Once you've invested time, money, or effort into something, you feel pulled to keep investing in it, even past the point where the math says you should stop. Not because continuing makes sense, but because stopping means admitting the investment already made was wasted. Casino owners fall into this exact trap, and it's almost poetic because it's the same trap their entire business model is built to exploit in every gambler who walks through the door. Here's how it plays out in real life. You've spent $800 million building your resort. 2 years in, it's underperforming. Maybe the location wasn't as strong as projected. Maybe a competitor opened nearby with a bigger, newer property. Your revenue is coming in 30% below what the model predicted. At this point, the rational move, the purely financial move, might be to cut your losses, restructure, sell, or even close certain sections of the property that aren't earning their keep. But you don't do that. You can't, psychologically. You've already spent $800 million. Walking away now doesn't just mean losing future profit. It means confronting the fact that the $800 million might have been a mistake. So instead, owners do what almost every failing casino in history has done. They double down. They pour another $100 million into a renovation. They add a nightclub. They add a celebrity chef restaurant. They convince themselves that just one more addition will turn the tide, because the alternative, admitting the whole thing was miscalculated, is too painful to sit with. This is not a hypothetical. This is a documented pattern, and there's a real case that shows exactly how it ends. In 2012, a company called Revel Entertainment opened a casino resort in Atlantic City called Revel. It cost $2.4 billion to build, one of the most expensive casino resorts ever constructed at the time. It was designed to be the property that would revive Atlantic City, competing directly with the glitz of Las Vegas on the East Coast. Glass towers, a rooftop pool, high-end restaurants, everything built for a market Atlantic City hadn't fully proven it had. Revel lost money almost immediately. Within a year, it filed for bankruptcy. Instead of walking away, the company restructured its debt and kept operating, convinced the property just needed time to find its footing. 14 months later, it filed for bankruptcy again. Even after the second bankruptcy, it kept running, kept trying to attract a buyer, kept believing the flagship property could be saved. In 2014, just over 2 years after its grand opening, Revel shut its doors completely. A $2.4 billion building sold at auction a year later for $82 million. Roughly 3 cents on every dollar it cost to build. The people who ran Revel weren't incompetent. They understood casinos. What they couldn't do, what almost nobody in that position can do, is separate the size of the investment already made from the decision about what to do next. Every dollar already spent felt like a reason to spend one more, right up until there was no one left to spend it on. That's the trap sitting underneath this entire industry. The house is built to exploit the sunk cost fallacy in every player who sits at a table telling themselves, just one more hand will get their losses back. But the person who owns the house is exposed to the exact same psychological force at a scale of hundreds of millions of dollars, with regulators, lenders, and thousands of employees watching every decision. Revel wasn't an isolated case, either. Atlantic City alone lost 4 other casinos in that same general stretch of years, each one carrying its own version of the same story. A big opening, a rough first year or two, a round of reinvestment nobody could really afford, and eventually the doors closing for good. When an entire city's casino district loses roughly a third of its properties within a decade, it stops looking like a string of unlucky individual decisions and starts looking like a structural feature of the business itself. The pattern isn't the exception in this industry. In markets that get overbuilt, it's closer to the default outcome. Let's talk about what actually determines whether you end up profitable or you end up like Revel. Here's the optimistic version of this business. You build or acquire a mid-sized regional casino for around $300 million. You're in a market with limited competition. Maybe you hold one of only 2 or 3 licenses in your state. Your occupancy rates stay healthy because there's genuine demand and no oversaturation. Your gaming floor generates around $90 million a year in gross gaming revenue. Hotel and food and beverage bring in another $60 million. After paying your staff, your debt service, your marketing, and your compliance costs, you're left with a net operating profit somewhere around $25 to $35 million a year. On a $300 million investment, that's a real return, something in the range of 9 to 12% annually. That's the version of this business that made billionaires out of people like Sheldon Adelson. Here's the realistic version, the one that plays out far more often. A new competitor gets a license 20 minutes down the highway. Your customer base splits. Your gaming revenue drops 15% in a single year. To respond, you spend $40 million renovating the gaming floor and adding a new restaurant, funded by additional debt, because the sunk cost of the original build makes closing sections or scaling back feel unthinkable. The renovation doesn't bring back the lost customers, because the customers didn't leave because the restaurant was outdated. They left because there was suddenly somewhere else to go. Your debt service increases. Your margins compress. You're now running the property at close to break even, sometimes below it, and every year you stay open, hoping the market turns around, is another year of capital being poured into a hole that opened the moment the second casino got its license. Now stretch that realistic scenario out 5 years instead of 1, because that's how long these situations actually take to fully unwind. Year 1, revenue dips. You tell yourself it's a temporary dip. Year 2, you approve the $40 million renovation, financed with new debt on top of the debt you're still servicing from construction. Year 3, the renovation is finished, but so is a new hotel tower the competitor just built, and your dip has become a trend. Year 4, your lender starts asking harder questions at every quarterly review, and you're renegotiating covenants instead of planning growth. Year 5, you're either selling the property at a steep discount to someone who can absorb the losses, or you're standing where Revel's owners stood, filing paperwork that turns a multi-billion-dollar building into a line item in a bankruptcy court. None of those 5 years involved a single bad decision that looked obviously wrong in the moment. Each one looked like the reasonable next step, given everything spent before it. That's exactly how the trap is built. It never feels like a trap from inside a single year. It only looks like one when you zoom out. The difference between those two outcomes isn't really about how good you are at running a casino. It's about market saturation, timing, and whether you're willing to make the unemotional decision to cut losses before they compound. Most owners aren't willing to do that. Revel wasn't willing to do that. And the psychological reason they weren't willing to do that has a name, and it's the same name printed, in a sense, on every losing ticket that gets left behind on a casino floor every single night. So if you actually want to own a casino, here's the honest version of what you're signing up for. You're not buying a machine that turns gambling into money. You're buying a hospitality empire with a gambling license stapled to the front of it, one that requires 9 figures just to open the doors, thousands of employees to keep running, and constant vigilance against the exact same psychological trap your business is designed to profit from in everyone else. Think about the strange symmetry of it. Every night, on your gaming floor, there's a player somewhere telling themselves they can't walk away now, not after everything they've already put in. Down the hall, in an office with your name on the lease, there's an owner telling themselves the exact same thing about a renovation, a marketing campaign, or a loan they took out to cover last quarter's shortfall. Neither one of them is stupid. Both of them are running on the same piece of human wiring, the one that treats past investment as a reason to keep going, rather than information to weigh against the future. The casino industry didn't invent that wiring. It simply figured out, decades ago, how to build a business model on top of it, never expecting that the people building the business would end up standing in exactly the same trap they built for everyone else. The house always wins, they say, but the house is a business first. And businesses, unlike slot machines, don't have the odds quietly rigged in their favor. They just have bigger numbers, bigger stakes, and the same very human tendency to keep playing the hand, long after it should have been folded.